Stocks closed mostly higher today off of news from wholesale prices. We actually saw wholesale prices go up more than expected, but much less than what we saw last month. So the markets rallied a bit. We saw Treasury yields drop a little bit today, especially after that 1 o'clock 10-year Treasury auction. But what's going to happen tomorrow? We got the big CPI number, and then earnings season kicks off on Friday. But our guest today is very optimistic. He actually thinks we're going to have a big-time fourth quarter rally. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny, and it looks like it's very hot out there, Toby, in Scottsdale, Arizona. Okay, sunny and warm today. You forgot to send me the forecast. But with us today, we have Rhys Williams. He is the chief strategist from Spouting Rock Asset Management, located in Bryn Mawr, Pennsylvania. Rhys is coming to us from Miami, Florida, though, where we know it's nice and hot.
Rhys, where it's hot and it's humid, Todd. Remember that. Yes, 95 degrees with 2% humidity feels like 85, okay? 95 with 100% humidity feels like 125, all right? So let's get that through.
There's your weather report right there, ladies and gentlemen. Well, Rhys, welcome back to the program. We are so delighted to have you. Last time you were on Buy, Hold, Sell, you were very optimistic about the markets. Talking to you now off air, it sounds like you're even more optimistic about the fourth quarter. So what do you have to say about it?
Well, considering what happened in September, you had a real market, not a crash, but you had a real market fall. And that was really just driven by interest rates going up so much. And if interest rates hadn't have rallied so much based on a little bit of Fed speak or maybe too much Fed speak, I think the September quarter swoon wouldn't have been so bad. But given that entry point, now as we enter the fourth quarter, it's typically a seasonally stronger period. I also noticed that I think it was Oppenheimer did a very interesting graph on the third year of a presidential cycle, that the fourth quarter virtually always rallies since 1980. I guess 1983 was the first year that happened. But anyway, my point being, and that's obviously Republican presidents, Democratic presidents, good economies, bad economies. And so I think a lot of things are developing, and certainly the action in the market in the first week or so of October is positive. We had a lot of sort of bad news that we've sort of shrugged off. So I think that's encouraging. And that plus also the hedge funds are very net short, but have limited net long. So I think there's a lot of buying capacity if things start to move up.
Now, you're right about that. Well, we had Sam Stovall on the show, and he actually said that going back, I think it was 50 years, if you go back when the fourth quarter of a pre-election year, we actually saw stocks rally an average of 5.7%. So, and it was 100% accurate. It was incredible. However, now we have what, two wars going on. We have a lot of saber rattling with China and Taiwan right now. You have a U.S. economy where the consumer is, well, I don't know, they keep spending, but we keep getting word and messages that the consumer is becoming quite strapped right now, especially since they can't access credit. So it makes you wonder what is going to happen for the rest of the year. But Toby, what do you think? I mean, you were kind of optimistic. You're back and forth, saying, hey, look, you know what? I think this could be a good thing, but maybe we have to look at the headwinds.
Well, I won't bore you with my macro numbers because, I have a very limited skill set, but math is one of those skill sets. And when you look at 76% of discretionary spending in the top 20% of households by income, that's where the margin is. Yes, the people who bought the $75,000 F-150s with 14% interest rates are puking them up right now. Matter of fact, you can't hire enough repo people, according to my friends in the auto business, right? But that is not our economy. Our economy at the service level, remember we're 76% service, and then at discretionary spending, which is at the margin, is the top 20% of households in America, and we're kicking butt. At the bottom level, we have, as I say, we got 96 million people getting a monthly pension plan, so on and so forth. So it's going to get softer. But the other issue is there's 63 counties out of 3,300 counties in the United States that account for 75% of the GDP, okay? So don't send me a hate mail if you don't live in one of those counties, because if you add the next 15 counties, it counts for 81% of the GDP. So if you're going to do the math, what counts is those 82 counties. And some of those other counties could go to zero and we would still not have a recession. But that's the narrative people who don't do math. I would say this, Todd. The other thing is, what I love is there's now like 5 different narratives in the stock market, right? We got that Magnificent Seven. If you add the next 5, that means we have $782 billion of cash sitting on balance sheets that are getting like 5%. So they're getting a boost in their earnings. You know this, simply from the freaking monthly or daily dividends they're getting out of their corporate, money market fund, right? So even if the dollar was up, it's being offset by those trades. The second one I love, though, I don't know if I love it, is the Ozempic catastrophe. Oh. Who knew that now, full disclosure, I've been an investor in them a long time. I've been a user of Ozempic. I freaking love it. I think it's fantastic.
But look great.
Yeah, but just let me say, there's no question. If you're out to dinner with somebody or somebody's over your house or whatever, and they say, Rhys, I eat like half what I used to, just follow up and say, so how long have you been on the vitamin O? And when Walmart came out and the CFO says, it's shocking, but we're selling a lot less shitty food than we used to. And Pepsi comes out and then it goes down the line, the list of people who sell crappy food. The actual sales are, in some companies, have been crushed by, and that's only about 28 million people on Ozempic in the United States.
Yeah.
You get to a 50, a $70 million, people, the country will be broke because it costs $1,000 a month to somebody.
Yeah.
And the corporations are now coming out and saying, oh, by the way, our health insurance premiums are up 14%. So there's some very strong narratives. We have, 5 subsectors that we have been making a crap ton of money, Rhys. That's a scientific term. We're up 28%, actually 32%. I'm looking at the number right now. Good. And that includes dividends, because Rhys, I'm with you on dividends. When the world's got 25 cross currents all going at the same time, we have tankers that are 100% sold out for the next 2 years that are paying us 25% dividends. I'll take that all day long and just reinvest the dividends, and that's how we're making money.
That's good stuff. Well, Rhys, you manage a couple of portfolios over at Spouting Rock, and what are you telling your clients these days? I mean, it sounds like you're optimistic, but I mean, is it you looking at a 60-40 portfolio balance, or are you thinking something a little bit heavier on the equity side?
I think from right here, 60-40 makes a lot of sense, because I'm pretty optimistic that bonds are going to be your friend, or at least not your enemy, like they were in September. And certainly, I think the risk isn't that the economy accelerates in 2024. The risk is, frankly, it decelerates enough that you have some sort of mild recession. So I think having at least some bonds is interesting. I think if you want to be contrarian in the stock market, some of the bond proxy stocks have been slaughtered. I mean, REITs, look at even the non-office REITs that have pretty good underlying fundamentals, like industrials and towers and apartments. I mean, those stocks
are utilities, Rhys. How about utilities? The widows and orphans got to be just like storming Merrill Lynch right now.
I mean, Next Energy was taking your breath away. But getting back to your Ozempic comments, the market is gone. It's like candlepin bowling every day. I mean, look what's happened to the some of these healthcare stocks that even have some tangential relationship with your vitamin O. I mean, it is.
You can use that, by the way. Use it at the office, okay? They'll let you.
I got that, tucked away there. But no, seriously, I mean, it's amazing how, Baxter down 7%. I mean, it's just been Dexcom, one of the great, companies, and really it treats more type 1 diabetes, which isn't really impacted by weight loss. So, that stock's gone from like 120 to 70 in since Wegovy and Ozempic became household names. Anyway, just an example. They're just falling knives right now. I'm not saying you go out and buy a bunch of them today, but you should definitely have some on your screen, because the valuations now are pretty compelling. And in my view, the healthcare utilization was actually, pretty good in the third quarter. I think the earnings reports are going to be fine. Just as, by the way, Constellation Brands and Pepsi Cola had pretty good things to say. People still like to drink beer and they like to eat potato chips.
I'll add one more to the pile there. So I was a big fan of Inspire. Inspire is a company when you have to wear a mask as you snore, or you have whatever that thing is. The manufacturer had serious problems, and they had to recall all these masks. So Inspire and put something out. I have a ENT friend who makes a very nice living putting these in for $42,000 per patient, by the way.
Wow.
And all of a sudden you don't have to wear the mask. All of a sudden you're not, doing this horrible snoring and all that stuff. That stock's down 40%. And the idea is there's less people, at the margin that are going to be using Inspire, and or reimbursement's going to go down. That's another vitamin O, victim that I never saw coming.
Yeah. Well, I think it's funny on the Walmart thing that they're going to blame a drug for the fact that people aren't eating as many Doritos. I mean, maybe it's the fact that a bag of Doritos costs $5.50 right now. It's actually it wasn't like it used to be years ago. But that's
no. The issue, Todd, is they measure the shopping cart, and these shopping cart sales per shopping cart are down about 6.5%. And then if you go where that 6.5% is, most of it's in the junk food, because if you're only eating half the amount of Doritos that you used to eat, you're not replacing them, as much as some people appear to be eating them weekly or getting new bags weekly. But it's the shopping cart size. Now I'm waiting for the one where people are losing weight, and then the clothing stores are doing better because people are, running out to get new clothes.
There you go. That's a great idea. Who knows? Well, listen, let's leave it on this block right now, because coming up after the break, we want to talk to Rhys a little bit more about the upcoming earnings season, which kicks off on Friday with the big financials with Citigroup. We have Wells Fargo and JP Morgan, and I want to get his insights on that, and also maybe some sectors to actually look at and maybe others to stay away from. But we're with Rhys Williams. He is the Chief Strategist at Spouting Rock Asset Management, and we'll be right back after the break. Please stay with us.
Buy, hold, sell, brought to you by CrossCheck Management.
Fashion and romantic. Can you and I be a fashion tonight? I wanna get lost in the music and feel tipsy from the wine. Speak of love, I won't refuse it, and the music will speak the language of love.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Welcome back to Buy, Hold, Sell. Well, stocks were up mostly across the board today, but really everybody is anticipating the big inflation number that's coming out tomorrow. The Consumer Price Index will be released at 8:30 a.m. New York time, and all eyes are expecting a 0.3% increase, which is much better than what we saw 1 year ago, which was up 3.6%. So we'll see. It's definitely a marked improvement for inflation, and obviously with the Fed tightening and hiking rates, which leads us actually into earnings season, which kicks off on Friday with three big financial firms. You have Citigroup, Wells Fargo, and you have JP Morgan all releasing earnings. But I have to tell you, Rhys, I'm not so sure. I'm not optimistic on the financial sector. I don't know how you feel, but with those higher interest rates, that means a lot more money being paid for deposits. But what do you think?
Yeah, I think that net interest margins are in general not going to be very good. I think everybody's figured out that banks get disintermediated faster. And then you think about, what do banks really lend money for? They lend money for commercial real estate projects. And because interest rates have gone up so much, they don't pencil out anymore. So I think they got hurt in two ways. So, we're not super optimistic about bank earnings.
Well, Todd, I'm going to be very interested to see, because, the Fed did such a good job in managing Silicon Valley Bank risk, that I'm really interested to see when Citibank, even Jamie the God, JP Morgan, when they show how many hundreds of billions of dollars. They're underwater on their, portfolios that they didn't hedge because God knows why. And because they're a too big to fail bank, they somehow get this, leniency that, you can be upside, I think it's at JP Morgan, $850 billion on your bond portfolio, and you don't have to mark that to market. If you had to mark to market, which in the old days, let me tell you, in the old days, that's what we had to do. They would be, I believe the correct term is shit out of luck here. And Citibank is horrific. They've been horrific for 2 years. I'm with you there. I'm actually short Citibank and a couple other banks just with options because they're driving me nuts.
That's probably a good idea.
Valuable.
Well, they've been really focused actually over the last decade on consumer credit, and with higher rates right now, people are tapped out. They just can't access credit. That's always been the one issue. It's been their Achilles heel, and for some reason they've stuck with that game plan. But I think they're going to be out of the three. They may be the biggest disappointment on Friday, but we'll see. But Rhys, what about tech earnings? You have Tesla coming out on the 18th. The week after that, we have Apple, we have Microsoft. We just got a breaking news report today while we're on the air that the IRS is now given a bill to Microsoft saying they owe another $29 billion in taxes. I mean, that'll ruin your day. But
oops. I'm wrong zero. I thought it was 280 million.
Right. Yeah. No, somebody put the decimal point.
Even for Microsoft, 29 billion is not chump change.
Right.
Yeah, that's right. But what's your take on the overall earnings season? Because this quarter and people we've had on have actually been, for the most part, optimistic, thinking we're going to hit that 10% earnings growth for the quarter. Are you in the same boat with a lot of the bulls that are out there?
Well, to your point, I mean, big tech is what, 40% of the market, and so if they're okay, then the market will be, the S&P earnings will be okay, and I anticipate by and large they should be okay. More on the cost side, I'm not looking for big revenue surprises from big tech, but I think they've been managing very conservatively. Plus, they're getting the benefit of the higher interest rates on their cash balances, et cetera, buying back some stock. So I expect it will be at least in line, maybe slightly better for most of big tech.
Well, Todd,
and so I think that's been supportive.
Todd, I don't think it's surprising that, and Rhys knows this, when I ran a mutual fund, it was not like a hedge fund. I couldn't be in cash in my mutual funds. And so when you've like crawled up in a ball in the corner, sucking your thumb because the world is going to caca, or other companies, you see all these various risk factors, I would be buying the significant Magnificent 10 simply because that was the safe harbor. I mean, the idea that utilities used to, you used to go to the playbook in the old days. All right, buy some utilities when rates are going up. And really? So they're the only guys on ship. The market is hanging on these 10 because I include Salesforce and I include a couple other ones in that, Magnificent 10 or Terrific 10, I call them now. That if there's some, chinks in that armor, then we're going to have problems. But the fact of the matter is, again, just doing like simple math, there's really no chinks in the armor when you're getting that much cash flow out of your cash. And also, they're subscription based. It's not like they have to go and sell another 20 new things today. That's the best business model in the history of the planet, which always drives me crazy when we compare the 1960s and 70s to this decade. There were no subscription software business, for Christ's sake. IBM wasn't even a subscription, and now we've got 45 or 55% of how you do it of the entire S&P 500 on a subscription-based, zero incremental cost for new sale business model. You just can't compare the business models, and that's why I think that these guys are the safe harbor, and they're going to continue to do well. And oh, by the way, everybody thinks that Nvidia is selling at 125. Market cap, or price multiple. That's bullshit. If you take the actual earnings and you go forward, that's selling for a 24 PE. I just did the math today. So, to say that the Magnificent Seven are just wildly overvalued, they're at a little premium to the S&P. But if you take Nvidia out, they're 4-5% more than the S&P, and they're locked in growth. So that's why I'm bullish.
And
Okay,
getting
I
back
like
to your
that.
point on Nifty 50 back in 72, 73, those stocks sold at 60, 70, 80 PEs and had 15% earnings growth. You know,
Rhys, Jerry Tsai, the enterprise fund manager, who in 1969 was up 125%. I know that because I was at a family gathering and he was a guest there, and he showed me, he pulled a check out and he said, it was a check for, trust me, 125,918 or 918. That was, first off, the biggest check I'd ever seen in my life. Number two, I said, Jerry, what did you do? Did you sell your businesses? No, I run the enterprise fund and this was my bonus. And 2 years later or 3 years later, I was a finance major in college and said, I like this, and he was the first one to tell you that he was just riding the wave. And there was such a limited number of companies that were on that wave that, better than anybody. They're going to buy. They didn't even, hedge funds would buy, but we didn't even have algorithmic traders back then. These are actually human beings who had to go, buy more, because if I don't buy that stuff, I'm going to get crushed on my return for the year, which means I'm going to lose money. I'm going to lose money to manage. And I think we're in that stream, to your point. Mm-hmm. We're in the Nifty 10. And if you don't have those in your portfolio, you by definition are, trailing S&P 500. And a chimpanzee can beat the S&P 500 if you just stay more strongly in those until it pops.
Well, the Nifty 10, what's it called? The sexy 10. I like that. That's how we're going to coin it here at Buy, Hold, Sell.
Terrific 10. I got that one too.
There you go. So, Rhys, let's talk a little bit about the energy sector. We had a run up in oil. Now, today, we did see West Texas Intermediate drop a little bit. Mainly a lot of action over the past couple of trading days as a result of the war in Israel. But and then we had a big merger today. Exxon, $60 billion to buy Pioneer in an all-stock deal. That's incredible, guys. I mean, think about it. If you guys remember the R.J. Reynolds Nabisco merger, that was $20 billion. It was such a big deal. This is $60 billion, and they're clearly the kings of they're obviously cornering the market in that area of Texas and New Mexico. But what's your take on the oil sector right now, Rhys? We had Fernando Valle on at Bloomberg, and he actually has an $80 price target on West Texas Intermediate by the year end. But what do you think for that sector?
Well, I think having some exposure to energy makes a ton of sense. And I think the Exxon merger was basically Scott Sheffield, who was the CEO.
Scott Sheffield.
He wanted Exxon paper because I think he could have gotten more than that amount of money if he really wanted to do a sale. But he decided that, over the long term, Exxon would be a good steward of his capital. And I think that was really it, more than anything, because he's retiring. But I think that's an encouraging merger. And I mean, Pioneer is only sort of back to where it was in August. It was not a big premium at all. So I think the market reaction was just because arbitrage driven, driving Exxon down. But I think people over time will look at this merger more favorably.
Yeah, okay. Rhys, I'm curious. I mean, again, since we're talking about the good old days, I believe when they bought Mobil, they paid $11 a barrel for their existence. And
the price of oil was 11 when they did that acquisition. Yes.
Yeah. 1999, I think.
Yeah. So that was probably the greatest thing, and that was only like $40 billion, and that was like when $40 billion really meant something. They're going to roll this up. My wife's a petroleum geologist. For God's sake, I have all these crazy petroleum geologist friends who all work for mid-sized to majors, and they're just talking about how 5 years ago, 6 years ago, it was drill MF for drill. We get more. As soon as we get $1 in, we're putting $1 into the fracking, etc. And they would say, "Hey, wait a minute, the depletion ratio on these fracking wells is a lot faster than those old wells you old people used to drill." And I say, "Do it." And then 2014, 2015, oops. So that has left an indelible impression, Todd, on management now. And I love the idea of people saying, "Well, it's not an ESG thing," dude. Yeah, if they didn't buy that, then Chevron was going to buy it. Somebody else was going to buy it. They're great assets. they'll get all sorts of efficiencies, and the entire industry is rolling up because guess what? The money managers want them to A, buy back stock, B, pay high dividends, and C, not waste our freaking money again. And they got the message finally.
Yeah, and the single largest shareholder of Exxon stock is the teachers union in this country. So when everybody starts complaining, just think of the 5th grade teacher in Topeka, Kansas, driving around in a Honda is also an investor in that company. So you definitely want to applaud them. So
I'm sure they're all aware of that, Todd. I'm sure they're all aware of that.
There you go. So Rhys, finally though, we'll close out the show, but I have to ask you, what are you telling your clients now? Because I know you manage a couple of portfolios. Do you have any particular companies that you're focused on?
Companies, help us.
Sectors, something, we want to give the audience as we go into the end of the year.
So I think we talked about big tech. I'd be overweight big tech. I totally agree with you guys there. Either it goes up because there's the fourth quarter rally I expect, or they outperform if we're all wrong and the market goes down.
Win-win.
So I think that I think either way, it's that they're going to be a successful investment. I'm sort of intrigued by some of these beaten up REITs, because I'm also fairly optimistic that the bond yields are close to a peak and people really hate them. And to your point, utilities have become a dirty word, I guess, because they have solar energy exposure, some of them. And I mean, I still, what happened to Next Energy takes my breath away. So,
no kidding.
Florida
Light and Power. Let's go back to the old days, right?
FP&L. I mean, it's amazing. So I guess my point is that REITs, at least if it's an underlying asset, there's going to be a lot fewer projects penciling out with this current interest rate structure. So I think that supply that you're seeing right now is going to be diminishing as we go into 2024 and 2025. And these stocks have been slaughtered the last 2 years. So and they have good dividends, to your point. So I think that would be sort of my contrarian play. And then, like I said, I think you should have a list of healthcare stocks, maybe the anti-Ozempic stocks, because that they've been so slaughtered that it's too early to buy, because every time there's a new press release about a study, they go down 5%. But you should have that on your list, because I do think at some point these things are so oversold and utilization's up. People are getting their knees replaced, they're getting their backs done, they're getting lots of things are happening, and these stocks are just dog do right now.
Yeah,
okay,
that's an excellent term, by the way. Todd, I'll only add that the AI picks and shovels stocks that we own, many are SMCI's been a big winner for us. They're the ones who build the data. Essentially you call them and you say, I need 25 new data centers with 652 NVIDIA chips. Great, you want those tomorrow? I just drove through Fremont. I was visiting the company. If you go up the freeway from San Jose up to every damn building on that freeway, it says SMCI on it. I mean, it is truly amazing. But the AI spending has not peaked. We had the mania. We sold them, and we we're patient and bought them back. But there's two things. One is AMD now has a GPU that's going to be coming out that looks just as good and has a great software connection to the NVIDIA CUDA software. Right? There's other ways to play that. That play is not going away. Every CEO I talk to, like Rhys does, anybody else, is what are you doing for AI? And I says, well, I don't exactly know, but I hired 12 people to tell me what I should be doing, and I know we're spending a shit ton of money to get there, because I don't want to be the person who gets fired because I got outflanked on AI. And the productivity. I mean, one of our portfolio companies that I can't speak about because it's like under $500 million. They just did a deal for their AI in logistics that cut the largest logistics company in the world, cut their labor costs 30%. So CVS just put $25 million into outfitting just 10 of their 52 distribution sites, because you can't compete if the biggest guy in the world has 30% lower labor costs. B, labor costs are your highest part of logistics. C, logistics is 9% of the American GDP. Yeah. Then D, you better freaking figure out what those guys are doing and do it as well. That is not a trend. That is a sea change. My company is called Transformative Research. We look at S-curve, transformations, and we look at essentially the inflections. Well, the inflection has happened. And you can buy the picks and shovels at reasonable prices. I added NVIDIA today. But AMD were very strong on, and TS, semiconductor, because you can't afford not to do it. And then Symbiotic, we just added a couple weeks ago because of the robotics, because of this logistics deal. There is money to be made. There's money made in uranium, for crying out loud. There's money. I'm just looking at our list here. But if you don't have 60% of your portfolio in the non-treacherous 10, then you're going to be behind the market. And that's why the seasonality works, because we get down to the end of October, at least in the mutual fund world, you got to like settle up, right? And so by October 31st, if I don't own all those stocks on my print on November 15th, I'm going to say, well, no wonder he's a schmuck. He didn't have any of the right stocks. And then I can do the tax loss selling to minimize taxes. So, I mean, Rhys knows this, but you got to do a lot of work. October goes up because money managers, particularly of big funds and big mutual funds, it's a pain in the ass. You're switching stocks out to get, tax benefits. And then you get to November, and the stuff that you sold, if you had to trim, you want to buy back if you liked it, blah, blah, blah. So,
that's good. That's good. I like it. Well, we're going to close it out on that. Let's close out. Rhys, did you have one final word there?
I just wanted to agree that I think the biggest area for beat and raise in tech is AI. And I agree that story is not over. Even though it's not cheap, it's not over.
Yeah. Oh, I agree with that. It's definitely not over. There's a lot.
Hey, Todd, invite Rhys back. He's a smart dude. Okay.
Rhys is great. Rhys he says it all. He doesn't leave anything out there, and the audience loves him as well. So that's a win-win as far as I'm concerned. So let's close out the show there. So Rhys Williams, thank you so much for joining us today. He is the chief strategist over at Spouting Rock Asset Management. Go to spoutingrock.com for more information. And he's the headquartered right there in Bryn Mawr, Pennsylvania, which is the hotbed of Pennsylvania lacrosse, Toby. I just want to point that out.
Oh my Lord. We've done like 138 of these shows, Rhys. He has worked the word lacrosse into every one of the damn shows. I don't know.
Hey,
he's a Baltimore guy. What can you say?
I know, he's Baltimore. I know. And I love lacrosse, by the way. It's just that I have a real life. All right.
That's awesome. So, Rhys, thanks again for joining us today on Buy, Hold, Sell, and I definitely want to have you back, and definitely sometime soon, especially during this fourth quarter period. That'd be great. So on behalf of Rhys Williams and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. For tomorrow's show, keep it here. We got Christina Hooper. She is the chief equity strategist over at Invesco. Will be joining us as our featured guest. So you definitely want to check out Buy, Hold, Sell tomorrow for that. So thanks again for joining us, and we'll catch you next time. Take care.
Sure.
All right.
Buy, Hold, Sell, brought to you by CrossCheck Management.